Okay. All right. So we are live on YouTube now. We're live on YouTube. And we are also going to go live right now on this. All right. Not a problem. So 100%. So we're live right now. Okay. So thanks a lot, though, for joining us today. And I appreciate you taking the time to do that.
No, great. Thanks very much, Ezra. I'm very excited for today. I think we're going to have some very interesting discussions today, and I think there's a lot of interesting points that we're going to touch on. And I'm also very excited to get some good questions from our audience today.
100%, 100%. So, guys, as you can see, I'm with Jaco today, and welcome. Let us know where you guys are watching from. As always, we need to have an interactive webinar. Let us know where you're watching from, and also if it's your first time joining us today, let us know in the comments that it's your first time so I can welcome you. We try to have this interactive webinars every week, Thursday, and this is where we get with real estate experts like Jaco here, and also people who are in finance, property finance, and we discuss all the different experts about real estate investing, what you guys need to know, and what you guys need to avoid. You know, that's something that is not discussed very often. What do you need to avoid so you can save yourself some money? Not only that, but I mean, you can also be able to leverage and be able to build your portfolio in the correct way. Otherwise, I see Precious saying, watching from Northern Cape. Precious, welcome, man. It's good to have you here. And is this your first time watching, joining us on the webinar? Let us know if it's your first time. And if you just joined us now, let us know in the comments where you guys are watching from so we can welcome you. We need to know where you guys are watching from also, as you already have people from Northern Cape. Where are you watching from? If you just joined us right now, let us know in the comments there. Let us know in the comments there where you're watching from, please. This is my first time watching from Randburg. Oh, Tlovisile. All right, Tlovisile, welcome, man. You're going to have a very, very, very adding webinar today. And you're going to have like a very good experience with us here today. And we're going to try to add as much value as we can. And I think you're going to be coming to this webinars every time we host some webinars going forward. I see somebody, Precious saying, I started yesterday. Not good, man. Good to see you. See, Precious is back again today. She started yesterday, and which is incredible. And it's good to have you again. And we encourage you guys to also join us in the future when we're having this webinars. So we're going to be starting in 3 minutes. But before we do that, if you just join us now, let us know where you guys are watching from. Again, in the chat box. And so we can welcome you. Hi, I'm watching from Oliphant State. It is my first time here. All right, no problem, man. This is Yingawe. Okay, Yingawe, I hope I'm saying your name correctly. Good to have you here, guys from Oliphant State. And then I'm watching from Cape Town, not for the first time. Gosinatina, good to have you too. Okay, so we have Cape Town, Northern Cape, also have Oliphant State, and we have Randburg, guys, the guys in Johannesburg too. All right, now welcome, guys. Welcome, and thank you guys for joining us. As usual, if you are having any other social media or anything that you're busy with at this point, I just wanted you guys for the next 45 minutes to join me and Jaco and pay attention, and we're going to try to make this session as value-adding as possible. And I'm going to go through like some house rules in a few. And if you just join us right now, always let us know where you guys are watching from. So, first of all, the chat box, use it if you have any technical issues. If you can't hear me properly or you can't hear Jaco properly, then let us know, okay, you can't hear us properly, or if there's any suggestions or if there's anything else that you want to suggest, also let us know in the comments. And then second of all, I wanted to say that the Q&A box is for questions. So when we go through this session, you're going to have some questions, some ideas that might come on while we're still going through the session. And I want you guys to take this advantage of Jaco here and try to ask as many questions as you can about property structuring, any other questions that you guys want to know about. We're here to answer that, and that's why we do this session. So I want you to use the Q&A box for that. Avoid putting questions in the chat box because we might not be able to see those questions. And so try by all means to put all the questions in the Q&A box. And one more thing, I will put my free ebook in here. If you haven't got a free ebook, that's something that you must be able to get. And if you have got it, that's good for you. Otherwise, I want you to get the free ebook. And then also, I'm going to be sending you guys Prosperity, which is Jaco's company's website. Get in touch with Jaco, see what these guys do. They do some incredible stuff there. If you can see in the chat box, I'm sending you guys a link here, and I'll also send it by the end of the session. I see Cyril saying, hi, watching from Centurion Gauteng. Cyril, good to have you, man. Good to have you. And yeah, we hope that you enjoy this webinar with us today. Otherwise, we're very excited to give you guys like some value-added webinar today. And here we're going to be starting right now. Okay, so I see that a few more people just joined us now. If you joined us, just a quick one, Q&A box for all the questions. Avoid putting questions in the chat box. And also in the chat box, just let us know where you guys are watching from. And if it's your first time coming and joining us today, so we can welcome you. Otherwise, we're going to be starting right now. So today, my guest is Jaco Grobbelaar. Jaco is a property investor, structuring specialist, and international speaker. He founded Prosperity Enterprises to equip individuals to build their property portfolios through education, structuring, and support. As highly qualified financial specialist and a former CFO, Jaco has traded and operated across Africa and understands finance and simplifies financial and structuring concepts. Jaco, it's good to have you today, man, and welcome to our webinar.
Great, Ezra. Thank you very, very much. Thank you for the invitation, and thank you for everybody joining today. I'm very, very excited, and we're going to have a lot of fun today. So thank you very much.
So Jaco, for those who don't know you, who is Jaco, and how do you describe what you do in simpler terms?
You know, Ezra, so something that I often tell people when I introduce myself and so on, and when we speak about, you know, where do you come from and what do you do and so on, you know, is I was in corporate for a long time. You know, I worked as you mentioned now, I was a CFO for an international firm traveling all over Africa. And I did what I love, which was finance, but I didn't love all of it. And, you know, I especially didn't like working for someone. I don't know if you can maybe relate to that. So yeah, you know, I had my time in corporate, but I must also say I'm very thankful for that time that I had in corporate, you know, because there were certain lessons that I had to learn, and I was privileged to be mentored by brilliant entrepreneurs that could teach me so much, you know, things that I can apply today in my own business as Prosperity Enterprises. But looking at property, you know, I've been passionate about property since school. I don't know exactly where it started, you know, but it was at a very young age. Maybe it was when I read Rich Dad, Poor Dad, because I read that when I was just going into high school. But yeah, somewhere the seed was planted that I want to invest in property. And already in school, I was preparing myself for one day when I can buy property, you know, and then I started, you know, very much like you, I said, I will never, ever work for anyone, and I don't want to, you know, I don't want to be an employee. But then I started my business after school while studying. So I always studied and worked together or ran a business or so on. And I got this offer for a job. And although I said I'll never take a job, the first thing that went through my mind is, if I take this job, I'll be able to get financing to buy property. So I got to do it. You know, so I ended up taking the job. It took me 8 years or 10 years to get out of that, out of that side again. But like I said, I was thankful for that. And in that time, it helped me to build a significant property portfolio. So my wife and I bought our first property while we were still dating. I think we were 20 years or 21 years old. And then from there, we started building more and more properties into our property portfolio. And something that I often share with the audience is that I recently released an article on that, is that the first property transaction that we did, the profit that we made from that property transaction was a year's worth of salary. You know, okay. Ezra, and when I realized that, and what it was about a week's work that we were doing, when I realized that property is something that I want to be in, you know, and that is where, you know, we started saying we're going to focus on property. And about, you know, 4 years ago or so on, I think it's about 4 years now ago, we could actually move out and move full time into just doing property.
100%, 100%. So your story is very interesting, and I mean, I can relate totally of the idea of not wanting to work for anybody. And I must say that one of the things that took me a while to understand was that if you don't get a job or you don't have any income that's consistent, you're going to have struggles with the banks. So I think you made a good decision there, you know, and you've been able to leverage your employment, you know, to build up a good portfolio. That's a good one, because going at it head on is a little bit tough and it's going to take you a while and a lot of, you know, strategizing and becoming creative about the financing. So I just wanted to ask you, say, what are some of the struggles that you had when you started out in real estate investing, and how did you overcome them?
You know, Isra, so I think I'd like to start with what you've just pointed out, and that was getting financing. You know, I was so keen to buy property. You know, I wanted to buy property before I even had a job. And I know there's a lot of creative ways in which one can do that, and there's always a way to there's always a way to get to where you want to get to. But that was a challenge for us. I went the route of actually taking a job, you know, and for working for a salary for a couple of years and using that to get started, which is not everybody's route. Like I've mentioned, I'm thankful that I went that route, because there's certain things that I had to learn on that journey that I maybe wouldn't have learned if I went a different direction. For other people, it would be different, but that was a challenge or a struggle that that we had. And then I think something that's very important, you know, is through our journey as property investors, there's a lot of places where we've bumped our heads, you know, and where we've made mistakes. And something that I can tell the audience today is that you don't have to make all of those mistakes yourself. You can make them if you want to. You can bump your head. You learn the lesson well, you know, but it's not necessary for you to make all of those mistakes. Learn as much as you can, you know, attend events, read books, expose yourself to as much as possible. But that being said, there's certain things that you're also only going to learn by doing it. You know, the example that I always use, I always joke and say I'm a very, very passionate, very amateur surfer. I love surfing, you know, and I'll at least go down to Jeffreys Bay about 4 times a year to go surf. And, you know, I don't know if I should confess this, but I think it took me about 80 to 100 hours in the water before I really felt I'm getting the hang of this. You know, I'm getting onto the surfboard and I'm surfing, and I'm actually getting there, you know. And there's so many times that I would try and go out and go surf and fall off and almost drown 4 or 5 times, and eventually get out and I'll tell my wife, you know, listen, I don't think this thing is for me. And the joy and the enjoyment that I'm getting from it now, after I've definitely not mastered the skill, but I can at least get onto my board and surf a proper wave, is so fulfilling, you know, and it is so worth the process that I had to go through to get there. And it's the same with property investment. For you to start and for you to build your property portfolio, it's going to be difficult in the beginning, you know. Your first transaction, you know, just the overwhelmness of the conveyancing attorneys and the bond attorneys and all these documents and getting the financing and where to next is overwhelming. But by going through it, you learn how to do it. And the second time you buy a property, suddenly it's a little bit easier. And the third time you buy a property, it starts becoming, slowly but surely, it becomes second nature to you. And you start seeing where you can save money, what you can do to protect yourself better, clauses that you can put in your offer to purchase to protect you. So all of those are things that you learn, hopefully from other people, but some of them you learn through the process of going through it as well.
100%, 100%. So the main point there is just to be persistent, you know, and don't give up too early. As you said, you were also thinking surfing was not for you until you got the fulfillment of actually doing it for the 100th time. So one of the things I realize is, you know, practice makes you better anyway, you know. So the more you practice, you know, the better you get as you go. So one of the mistakes that we do as property investors is not knowing how to structure a property portfolio. especially maybe you're buying for the first time and you read a news article right now saying 100% bonds are booming. And you're like, you know what, I'm going to go and put in an offer and buy a property. So you don't do your homework on structuring your property portfolio. And that's what I wanted us to discuss today, to just touch on a few things like how to build a property portfolio. That's number one. To say, how does somebody, who doesn't know what a property portfolio is, build one? And the second part is, how do you structure it correctly? And touch on a little bit about the mistakes, and also touch on at the end to trust versus P2I Ltd versus buying it in your own personal name. So before we get into that, because right now we have like COVID-19 and people are a little bit skeptical about the COVID-19 if they haven't done their homework. My first question would be to you: is it still a wise idea to invest in property in South Africa today?
Absolutely.
Okay.
And I mean, it's such an important question, and often when we sit with our clients, we discuss this because if your mindset is not right, and if you don't believe that there's opportunity, the bottom line is that you're not going to move forward. So that's the first thing that we have to settle this morning or this afternoon, is that, does it make sense to still invest in property? Now, let's look at the numbers, because I think that's very, very important. If you look at property over the last 50 years, I don't know if you are aware of it, Ezra, but if you look at the growth rates of property over the last 50 years, there's only 3 years in the last 50 years where property prices actually declined. For the other 47 years, property prices increased. And you can take any 20-year cycle, whether it is now from 1960 to 1980 or 1970 to 1990 or 2000 to 2020. So any 20-year cycle, and you would see a year-on-year average growth of property of over 10%. So that is, now what I tell people is, what I love about property is you've got two returns. On the one side, you've got your capital appreciation, you've got your capital growth. On the other side, you've got what we call your net rental yield, which is your rental income. Now, if your capital growth by itself is already over 10%, you're already competing with most funds, and the type of returns that you get. Then we haven't even looked at, then we look at a property that you bought and you didn't even rent it out. Now imagine you're still earning rental income from that, the type of returns that you can get. Now, the mistake, Ezra, that so many people make is they get caught up in the short term. They start looking at, but what has property done in 2016, 17, 18, and 19, for example? And we all know that property prices has grown very slowly over the last couple of years. Maybe it's 4% or 5% or 6%, depending on the type of property that you are looking at. But people get caught up in that, and they start making their decisions for the next 20 years based on information of the last 3 or 4 years. And that's a very, very big mistake that people make. Now, one thing that I don't do is I don't try and time the market. I can try and speculate now, is property prices actually going to decline in 2020 with COVID-19 and everything? And there's a possibility that, that could be the 4th year in the last 50 years where we actually see a slight decline in property. But I don't invest for the now. My approach to property investment is not, how can I make a quick buck now? It's about building wealth that can sustain me, not just for my life, but for generations to come. So whatever market I am in, I make sure that I buy well, that I don't overpay for property. And I think the opportunity that we are sitting with now is we are in a deep buyer's market. And that means that you've got much more room to negotiate the purchasing price, which means you can buy at much better prices, which actually means now is a better time to invest in property than when things are going well.
100%. I definitely understand. I mean, property is a long-term game. It's just that we millennials, we like, everything is fast, you Uber Eats, everything is, just a button away. So when you invest in property, you want the profit now. But otherwise, I mean, it doesn't happen like that. I'm also one of those people who had like a relative business expectations when I bought my first property, to say, okay, look, this is going to be a long-term thing. It's not going to be making the returns and giving me the type of money I was looking for, because I was just buying my first property thinking that if I buy it and then I won't get a job, So after I bought it, and I mean, I'm starting to do the returns there, I'm starting to get tenants and all that stuff. I just realized, look, I probably need to look at, other sources of income or other ways to create some money while I'm building my portfolio, because it's a long-term game. So my second question to you would be to say, for somebody who's looking at this, say, okay, I want to become a real estate investor. How does one prepare themselves to become a real estate investor?
Great stuff. So for me, Ezra, the first thing that is so important, and the first investment that you have to make is in yourself. You have to be prepared as a property investor, because it's big amounts of money that you suddenly start working with. You might be used to working with thousands or tens of thousands. The moment you buy a property, it's hundreds of thousands or millions or even more. So be prepared, educate yourself, and make sure that when you start this game, that you have covered the basics. After that, your structuring is critical. And I believe that's what a lot of today's questions are going to be on as well, is how do you actually structure your property portfolio? Now, for me, structuring is like the foundation of a building. Now, think about a foundation of a building. There's no direct or immediate benefit from having a foundation. You can't go sit in the foundation and enjoy the space. You can't have a direct benefit of having the foundation. But all of you know as good as me that if your building doesn't have a foundation, everything that you are building on top of that is at risk and could be jeopardized. So for me, the structuring of your property portfolio is the foundation, is like the foundation of a building. Just this morning, I sat with a client that we were looking at restructuring. The client sat with 13 properties in his own name, and he's at a point now where he has to restructure it. And the total restructuring costs, looking at transfer fees, capital gains tax, transfer duties, depending on which route we go, could be as much as 1.2, 1.3 million rand to restructure the portfolio. That's sunken cost. That's money that you have to pay, but it's sunken costs. It's an expense that needs to be put through now to fix the structure. So do yourself a favor and set your structures in place before you get to that place, and save yourself a lot of money. And the bottom line is you are going to have to restructure somewhere. A lot of people think, no, I can just buy it in my own name. But at some point, it is going to cost you a lot of money. Even if you keep it till the day you die, firstly, you're going to be limited in many ways in growing. But taking that out of consideration, just your costs on death on the property portfolio that you have built up is massive. The example I always use is if you are sitting with a 20 million rand estate, when you pass away, you can work on costs on death of about 5 to 7 million rand. So a quarter to a third of your wealth will be wiped out if you built it in your own name on a 20 million rand estate. So that's one of the many benefits of having the right structures in place. So that's one benefit. Another benefit, and we touched on it now, all referring back to this being the foundation of your property empire, is the size of the property portfolio that you can build. Because when you apply for financing, for example, in your own capacity versus in a structure, whether it is a trust or a company now, the banks look at you differently. When you buy in your own name, you fall under the National Credit Act, and you have to comply to certain requirements, and the banks look at you in a certain way. Whereas if you are buying in a company or a trust, the banks look at you in a different way, and that enables you very often to build a significantly bigger property portfolio.
100%. So some of the bond originators out there will give you an advice to say, okay, if it's your first time you're buying property, buy it under your name, because it's easier for them to do the application. But besides that, let's say you're an entrepreneur or you're a self-employed person, then you're like, okay, if I buy in my company doesn't have 2-year financials, so I can submit that. And then what if I buy with my company using my name? How do you structure that? That's the big question that I wanted to ask, because a lot of bond originators will tell you, okay, pay yourself, build up some sort of financial track record in your personal name, and then buy in your personal name. And they don't even tell you that you can actually use your personal capacity to buy in a new solvent company. So, which is something I wanted you to touch on. But I wanted to say, while you're answering that, I also wanted to ask for somebody who's saying, I'm confused between buying in my name and buying through a company and buying through a trust. Which one should I do? What would you advise on that too?
Great. So for me, there's two ways that you don't buy property in, and there's two ways that you could buy property in. Number one, you don't buy property in your own name. If you want to buy property and build a property portfolio, don't buy it in your own name. There's a number of reasons for that. Number one, it's going to limit you in the size of the property portfolio that you can build. Number two, your assets are exposed, because if something goes wrong, and things go wrong in life, sometimes you did nothing wrong, but something goes wrong with you and you're in financial distress or in trouble, and you stand the risk of losing everything that you've built up. Number three, we spoke about estate planning and the cost on death. And then number four, you are going to pay too much tax. So that's a no-go. The second way in which I don't recommend people to buy property is in a company where the shares being held in their name. Now, that is already better than the first suggestion, but the reason why you don't want to do that is because if you buy in a company and the shares of that company is in your own name, you've got some of the protection, but not all of the protection, because that shares, or you are still the final owner in effect of those properties. So if something goes wrong with you, those shares that you own is still an asset on your name. And one day when you pass away, the shares in that company that you own forms part of your estate. So what that results into is there's two viable structures in which you can buy property, and that is in a trust directly. So in other words, you've got a property trust buying the properties, or buying in a company, but where the owner of that company, the final owner of that company, so in other words, the shareholder of that company or that company structure is a trust. Now, the beauty of a trust, so you'll see in both of these structures, there's a trust involved. Now, the beauty of these structures is in the trust. And, you know, the concept of a trust is as old as 1,000 years, but it's a very interesting concept, because you know that you cannot own a trust. A trust is not something that you can own. And that's not a bad thing. That's a good thing, because if you don't own it, it can't be taken from you. So a trust is a vehicle that you own, that you not own. A trust is a vehicle that you use to build your property portfolio in. And in a trust, you have a founder, who's the person that establishes the trust. You have the trustees, which are almost like the directors of a company. You know, those are the people responsible for running the affairs of the trust. And you have the beneficiaries. Now, the beauty of the beneficiaries is it doesn't work like a shareholder. A beneficiary in a discretionary trust doesn't have a vested right or claim to the assets in the trust. So that means if you're a beneficiary of the trust, you can't say, listen, I'm one of 3 beneficiaries, 33% of this trust or the assets of this trust is mine. It doesn't work like that. It is done by the discretion of the trustees. So immediately the assets and everything that is built under it is not built in your name. It's built outside of your name separately, and it gives you the protection. It gives you the you know, estate planning benefits. It enables you to build a bigger property portfolio, and it gives you phenomenal tax benefits if you structure it correctly.
100%. So one of the main questions about trust is the maintenance, and obviously establishing a trust, the costs associated with that, versus, you know, building under a company which you're still the shareholder, which you are a little bit protected, but in the long run, you know, you can be able to convert the shares into a trust account. So what do you advise a person, when do you advise a person to consider opening up a trust account?
And may I be very direct?
Yeah, please.
You know, something that I tell my clients very, very often is don't be penny wise, pound foolish. You know, a trust is not that expensive to set up, and to administer a trust is not that expensive, but the benefit that it will give you is phenomenal. And the savings that it will give you over your lifetime is massive. You know, even changing the shares of your company to a trust later on could be very, very expensive to do. You know, my wife and I was, you know, to go back to our story, my wife and I, she was my girlfriend that time. If I remember correctly, we were 19 or 20 years old. And that was the first time I was exposed to trust. And I registered my 2 trusts that day. You know, I had no idea how I'm going to buy property. You know, the registering the trust costed me a couple of $1,000, and administering the trust cost me a couple of $100 a month. But I knew that if I want to build something big, I'm going to have a strong foundation under it. And I was willing to pay those costs because I knew that that would take me to where I am today and where we want to go tomorrow by having the right structures in place. So the couple of $100 administration costs that a trust would cost you a month is, for me, an exceptional investment that you can make part of building your property portfolio. So my advice, and that's my personal opinion, but I think it's good advice, is have your structures in place before you even buy your first property. You don't have to have it open 3 years before you buy your first property. But if you know you're going to be able to buy your first property in 3 months' time, get your structures ready. And for me, the bare minimum is a family trust and a property trust, because your family trust is all your personal assets over your lifetime will be built up there, number one. And number two, all the money that you push into your structures, whether it's companies or trusts or whatever it is, I prefer to do through your family trust, because the money, the funds will flow from you to your family trust as a donation, and your family trust will then lend to all these other entities. And the reason why we do it like that is one day when all these entities are making money, all that money that you pushed in to build this property portfolio, you can then get back by repaying that loan tax-free, and you can go enjoy that money in your family trust where you can buy yourself your personal assets. So that for me is a very good structure to start with, where you've got your family trust and your property trust.
100%. That makes perfect sense. So we can go into this trust thing in detail, but I think that you need you will be doing like a workshop where everybody should attend, because there's some questions on how much the donations limits that are going into the trust accounts, and obviously how you should be linking bank accounts and all that stuff for people who are much interested in this, because this is a very interesting structure that you're talking about. So let's talk about some of the benefits versus when you're using a trust and the company. This is a company building a portfolio. Let's talk about the tax benefits there. What are the tax benefits that as somebody looking at when you're using the correct structure there?
Now we are getting to the meat. So this is now, so we've determined now how to buy property, now not to buy property. And we said the 2 options that you have specifically from an asset protection perspective is you want to be sure that you've got a trust that is the final owner of whatever you hold. So whether it is in a trust directly or in a company. But now the question comes up, so between those 2 structures, what are we going to do? Are we going to have a property trust owning the property directly, or are we going to have a company with a trust owning the shares in the company and buy the property within the company? Now, a trust is taxed at 45%, a company is taxed at 28%. Now, usually when people hear that, they say, well, that makes it very obvious then a company is the way to go. And that is a benefit, the lower tax rate that you have in a company. But the problem is that a lot of people don't understand how the conduit principle in a trust works, because even though your tax rate is 45% in a trust, you're never going to pay 45%, because whatever profit you make, whether it's a capital gain or whether it is profit from your rental income less all your expenses, that profit can be distributed to any beneficiary, and the beneficiary would then pay the tax in their personal capacity. So let me give you a practical example. You've got 2 kids that needs to go to university. You need 400,000 Rand this year, 200,000 Rand for each to send them to university, for example. Now your property trust could distribute that money to your family trust, and your family trust could pay the university fees for the 2 children, 400,000 Rand. And when we prepare the financials for the family trust, we allocate it as a 200,000 Rand distribution to the one child and a 200,000 Rand distribution to the other child. In that regard, your property trust is not going to pay any tax. Your family trust is not going to pay any tax, but your kids are going to pay tax in their personal capacity. But because that is the only income that they have earned for the year, which is the distribution that was made from the trust, they are on a very low tax bracket, even a lower tax bracket than what a company would be on. And in that way, the trust was a very, very good structure to do the distributions through. But if you don't have, so let's say, for example, you are doing so well. I always use this example. I had a friend the one day phoned me and he was so upset. And I'm like, buddy, what's wrong? What's going on? And he's like, you know what? My father moved a lot of money through my daughter, and now she's on a 45% tax bracket. And the money that I wanted to move through, I can't move through her anymore. And I was laughing at him, and I say, hey, buddy, this is first world problems. You know, there's people that actually have real problems in life.
No, those are nice problems to have.
Those are nice problems to have, but that's a very nice illustration of when a company starts becoming a better option. And that is when you and your children and your grandchildren are all on such high tax brackets that there's nowhere for you to distribute the money to anymore. And in that regard, or at that stage, the company structure starts making sense. So a lot of people say, but I don't have kids now, I'm not married now. But remember, you don't have a tax problem now either. Your tax problem is going to be 10 or 20 years from now as you have grown this property portfolio. That's when you think you might have a tax problem now, but as you build and grow, that tax problem becomes bigger. So you want to set up your things in such a way that you have the best benefit for now, but also for 5 years from now and 10 years from now and 15 years from now.
100%. So one of the things that me and you were discussing when we started today was you were saying that you are preferring to use the right structure so you can be able to use leverage to build a bigger property portfolio. So how can somebody use leverage to build a bigger property portfolio, especially if they have the structure correctly?
Great. So just for all our viewers there that you know, just to cover on what we mean by leverage and so on. Leverage is using the bank's money or using other people's money, you know, and that's one of the things that I absolutely love about property. Why Ezra and I love property so much is you can build a big property portfolio with very little of your own money. You can use the bank's money. I mean, if you compare it to other investment or asset classes, with a property, the banks are willing to lend you up to 100% of the amount of the property. So the only cost that you have to cover out of your pocket are maybe the transfer fees and the bond registration costs. Whereas with many other investments, you have to have a big chunk of the money yourself in order to make the investment. So the example that I always use is, imagine you have, for example, 100,000 Rand to invest. If that investment grows with 10%, your 100,000 Rand grows to 110,000 Rand, right? But if you want to invest in property, you're not going to go buy a 100,000 Rand property with 100,000 Rand. You're probably going to go buy R1 million property and use 100,000 Rand of your own money and let's say 900,000 Rand from the bank. Now, if that investment grows with 10%, it's not your 100,000 that grows with 10%, it's the R1 million that grows with 10%. So the R1 million grows with 10% to 1.1 million. You owe the bank 900,000 and you have turned 100,000 into 200,000. So even though the investment only grew with 10%, your equity or your cash grew with 100%. And that's what leverage does. But leverage works both ways. It works towards the negative as well. And that's why property, which is an asset that tends to keep its value very well, and leverage go so well together. So to answer your question, Ezra, from a practical perspective, I just wanted to give a little bit of background when we look at leverage, what we are talking about. But from a practical perspective, when you now want to start making investments, the beauty of property is you can buy R1 million property with as little as 40,000 Rand of your own money. And you can even go borrow that if you wanted to. But you can make investments with very little of your own money. Now, if you buy property on your own name, as we said, the banks only look at the value of the property and the collateral, and then, of course, your income and whether you can afford the loan that they want to give you. And that's why I very, very, very often sit with clients that's got 2 or 3 or 4 properties in their name, and they can't move further because they can't get more lending or financing for their property portfolio. Now, when a company or a trust is buying the property, the banks don't look at 2 things now, they look at 3 things, because they look at the collateral, which is the property you are buying. They're looking at the financial statements of the entity, if it is an entity that's already operating, and they are looking at you as the trustee or the director signing surety. So, but because the banks are now looking at the entity as well, over time it becomes possible to get financing for many more properties than what you would be able to get financing for in your own name. So that is a critical, or that's a very, very big advantage of having the right structures in place, is based on the size of the property portfolio that you would be able to build over time.
100%. I think that's a very good answer, and also it's like simplified, for everybody else to understand. But one of the things I wanted to ask you before we open up the Q&A is, what are some of the common mistakes you see some of your clients are making when they structuring their property portfolios, especially, let's just put it like that. So what are some of the common mistakes you see? Like, okay, this happens all the time, now and now again, that's coming on your table.
Okay, how much time have we got?
Well, the next 5 minutes.
Let's go through a couple of that mistakes. The first mistake that people make is they don't do their structuring, and they start buying in their own name, and they think they'll fix it later. Now, it can be fixed. We actually already had somebody asking now in the Q&A, and we'll answer that in detail. But if I now did buy property, can I restructure? And the answer is yes, but it comes at a cost, and it's an unnecessary cost. So the first mistake that people make is they don't structure. Then I think a mistake, and very few people in my industry would say this, because, for a structuring company, that is their revenue, is I think a lot of people have structures that's too big for the property portfolio they're building. It doesn't help you've got 10 trusts and companies, but you've got 2 properties. The structuring cost and administration cost doesn't justify your investment. And that's actually a question we discussed earlier, is have the right structure for where you are at. I've got many entities, but I've got properties that justifies all of those entities. But when you start out with a simple structure. Don't have 5 entities for 2 properties, Start out with your family and your property trust, for example. And as you grow your property portfolio, maybe after you've gotten to 3 or 4 properties, then you can start looking at expanding that structure. And then not so much with structuring, but I think with, maybe answering the question that you asked earlier as well about mistakes that people make when they buy their first property. I think one of the biggest mistakes people make is they pay too much. There's a saying that we all use that is so true, and that is, you make your money in property when you buy. So you want to make sure that when you buy a property, you buy it at a discount, you buy it at a good price. That's a very common mistake I see. And then also, I think a mistake that I often see is in the offer to purchase. You forget to put certain clauses in your offer to purchase that can save you a lot of money. Let me give you one example of that. You simply crossing out one word, which is the seller's conveyancer, and putting in, you want to use the purchaser's conveyancer. In other words, you want to use your own conveyancing attorney for the transaction, an attorney that you know and have negotiated a fee with beforehand, can save you on every single property transaction that you do anywhere between 5 and 10,000 Rand. That's money out of your pocket that you saved simply by using your conveyancing attorney instead of the seller's conveyancing attorney.
100%. So we're going to be opening up the Q&A now, but before we do that, I have 2 more questions. One is, tell us a little bit about what you guys do at Prosperity Enterprises, and obviously how you help other people make sound structured decisions. And then the second one, I'm just going to put it both together, is if Jaco had a superpower, what would it be?
Oh, goodness. I'm not sure if that one I should answer out loud, but let's start with the first question. And with the first question, I'm going to buy myself some time to think about answering the first question. I'm going to buy myself some time to think about the second question. But, so on that, Ezra, I think you've summarized it very well. When we started, we were a property investment, structuring, and education company. The thing that brings me the greatest joy as an individual is helping people to actually create financial freedom through property. And that's exactly what we do. We specialize in structuring, so we make sure that all of our clients has got the right structure set up and administered to build their property portfolios. And we also assist them in the journey as they start building their property portfolios to surround themselves with the right people to create success in building their property portfolio. So We assist very much with the structuring. I do consultations with my clients as well, where we look at where they are at and what their needs are and what structures needs to be put up for them, and also for people that already have property and want to restructure. I almost sit on a daily basis with clients that want to move properties, and we look at the best way to restructure those properties to the right structures, you know. So that's a very, very big part of what we do. And as I told you before we started today, you know, that's where this business started. And then we saw so many of our clients that are very eager beavers, and, you know, they just go out and they start buying property, but they don't necessarily have all the tools or resources or education to make wise decisions. And that's where the education component came in, where we help our clients and educate them to make sure that they've got that foundation from an education perspective to actually be property investors and to build their property portfolio.
100%. So we're waiting for the second question. So if you had a superpower,
I was hoping you're going to forget about that one. But I think if I could have any superpower, and this can really be used for good or bad, so don't make assumptions here, is I would have liked to be invisible.
That'll be interesting. That'll be an interesting one. That'll be an interesting one.
That enables me to know a lot of things, you know. So I'm actually after, it's my curiosity that is striving for that superpower.
Definitely. Okay, so let's get into the Q&A. So we have Mark here. He's saying he has two questions. This is a long question, Mark, but I think that we can be able to help you answer that. First question is SARS tax rules of Section 13 of tax income. There is a formula. Please clarify indicating what you are able to claim for on residential properties built after a certain period. Please clarify the period which exceeds 5 or more units, where the property sale value allows the investor to claim back a portion of the purchase investments. Please provide an example.
Great. Okay. Mark, you're going to make me work very hard here today, but that's all right. That's quite a technical question. And just to quickly touch on Section 13(6) and what that entails is this is a section in the SARS tax rules that was established to promote, let's call it, development and infrastructure in South Africa. And how it works is that if you buy 5 properties in any one entity, whether it is a trust or your own name or a company, you can qualify for certain tax benefits or tax exemptions. And how that works is, now in South Africa, you can't depreciate property like in America. You know, in America, you can actually depreciate your property over a number of years and write that off as an expense. In South Africa, you can only do that if you buy 5 new properties in one entity. So the rule is as follows. The residential units must be new and unused, which means it needs to be off-plan properties or properties that has not previously been owned by someone. It has to be 5 properties at least. It has to be situated in South Africa, and it has to be for residential letting. So that's the requirements that you need. Now, if you comply, or if those requirements are all achieved or covered, you can then make use of the tax incentive, the Section 13(6) tax incentive that you've got. Now, that is a interesting calculation where you can, for example, let's look at new units. One can look at improvements as well, but let's specifically focus on new units, where you can, on new units, over a 20-year period, deduct 55% of the value of the property as an expense. So every year, so I want to see if I can maybe give you a practical example of this. I did look at a practical example the other day that we can maybe discuss. So just give me a moment that I can find that for you. If you, for example, have let me see if I can get an easier one, because I don't want to bring in all the technicalities and and complicated. So if you've got 5 properties of R1 million that you've bought, that's 5 million rand of properties that you have. Then of that 5 million rand properties, 55% of the value of that 5 million rand properties, so that would be just over 2.5 million rand, you can write off over a 20-year period. So 55% of the 5 million rand of properties, let's actually get to the actual numbers. So 55% of the 5 million is your 2.75 million rand property. And then 5% of that, which is 137,500, you can put through as a depreciation or a tax deductible expense that you can deduct from your profits that you are making and that you can save tax on. I hope that answers your question.
So he has another question. I think you can also just try to be a little bit short on that so we can go to other questions. His question 2 is saying, capital gains tax applies to property sold in the excess of 2 million in South Africa. What is the rules of when this applies, e.g., apply to properties bought at a certain period? Further, how is it calculated? How is the calculation determined? And what are the other options for the seller to claim for tax back on the capital gains tax?
Perfect. Thanks, Mark. That's a significantly easier question. So that one will go quicker. So with regards to capital gains tax, that 2 million rand that you are referring to is specific for your primary residence. So if you bought a property for 2 million rand and you sell it for 4 million rand, you don't have, and it's your primary residence, you don't have to pay tax on that 2 million rand capital gain. But if it's an investment property or not your primary residence, capital gains tax would be applicable from the first rand, although you've got certain exemptions that you can apply. So it's always good to have a tax specialist that can help you with those calculations before you just move or restructure properties or sell properties, to make sure that you know what the tax implications are going to be.
100%. So we have another question here from Anonymous. He's saying, how best to get properties from various clients, not from various sites for your clients? I'm not sure if you understand the questions. Do you understand this question?
I'm not sure what is meant.
I think he needs to elaborate a bit, I think you need to elaborate a bit so we can be able to answer the question. So we're going to pass this one. There's another question here is from Anonymous. He's saying, how do you transfer a property that's in your name into a property company? Okay.
Yes.
That's a good question.
So when we sit with your restructuring, whether you want to move the property from your name to a trust or from your name to a company, there's a couple of options that you've got. Let's start with the most basic option. Now, there's all kinds of legal technicalities, especially on bigger portfolios, that we can apply, but let's keep it simple for this conversation. What we very often do is we sell the property from our name to the company. So that means the company is the buyer, you are the seller. So let me give you a practical example again. You own one property that's worth 800,000 rand. You bought it for 600,000 rand, or let's say you bought it for 700,000 rand, but you owe 500,000 rand on your bond still. Now you sell that property to your company for 800,000 rand for the market value. The company applies for financing. Obviously, you as the director still sign surety for that loan. The company gets an 800,000 rand loan to buy the property. The bank pays out the 800,000 to the conveyancing attorneys. 500,000 of that 800,000 gets used to settle the loan. The other 300,000 gets paid to you. Now you've got 300,000 rand cash, and this is a very nice place to be because you've just killed 3 birds with one stone. Number one, you got the asset out of your name. Number two, you got the debt out of your name. And number three, you made 300,000 rand of capital available. That, however, is not free because your transfer costs and your bond registration costs you would have to pay in this example. And let's say that would probably be about 40,000 rand. So instead of 300,000 rand capital that you have available to invest further now, you've got 260,000 rand capital available that you can push into your company or your trust, and that you can use either for a reserve fund or to cover shortfalls if you have, or to use it as deposits for the next properties that you want to buy.
100%. So I see another anonymous attendee asking, I think he wanted to say 12J investments, but he didn't elaborate a bit. So we're going to also pass on that. If you want us to answer that question, just please elaborate a bit there so we can be able to help you. So Alfred's saying, please explain some more. I want to pay a property and register it on my company. So I think, Alfred, do you mean, you also need to elaborate that, or do you mean that you want to buy a property under your company, or what's the process there, or what do you mean exactly? Or what do you understand, Jaco, from this question?
So if Alfred means that he wants to buy a property in the company, what would the process be of that? So the first thing is your structures need to be in place. So you need to have your trust or your company registered first. Then when you submit the offer to purchase, you don't submit it in your own name. You submit it in the name of the trust or the company. And when you apply for financing, it's the trust of the company that applies for financing. Now, if you have a good bond originator, they will help you to structure this in the best way to get the best financing. They would still need your personal information as well, because as a director or a trustee, you would usually sign surety. So they would look at your income, etc. But the asset will be acquired in the name of the entity, and the loan will be on the entity as well.
100%, 100%. So I think you managed to answer Alfred's question. Okay, we have a question from A. Dalby. He's saying, does Prosperity provide tax and accounting services over and above the formation of structure, and what are the costs?
That is what I live, breathe, and eat every single day of my life. So that we definitely do that. That is what we help our clients with. And it depends on the structure that you have. So to register a trust, we've got very competitive pricing with the registration of the trust, and then we've got different ways in which we can administer the trusts for a couple of R100 a month, where you can actually have your financial statements, your tax returns, and all of that in your trust or company structures taken care of.
100%. So we have another question from Cyril here. He's saying, hi, Jaco, not to get personal, but out of interest sake, I have a twofold question. Firstly, is as an indication of what you will be able to supply as support and expertise, what is your property portfolio size now, and how many years did it take to accumulate? Secondly, using your suggested vehicle, what is the cost involved roughly per month? As a profession, I am an airline pilot, and managed to buy my first property at 21, the second one at 26, but it is in my own name. So I see what you are saying with running into financial problems. Okay. So I hope you can be able to answer that too.
Right, awesome. Cyril, yes, I'm going to answer some of your questions, not all of them. We've built an extensive property portfolio over the years. In a year, I buy anywhere between, I would usually try and buy about 10 properties a year. Some years it's more, some years it's less, depending on where we are at. But that actual number, I unfortunately don't disclose. And that is also very well structured in entities so that nobody would be able to find out, because that's one of the main reasons why we do use trusts, is to protect our assets, right? So from that regard, I think from the angle of the expertise and so on, we've got over 10 years of investing in property. As I say, this is what we live, sleep, eat, and breathe every single day, whole day. And with my finance background, we've specialized specifically in the structuring and the tax side of things to help other people with achieving that. And as I told Ezra before our session as well, everything that we teach and what we speak about is what we apply in our own investment portfolio as well. So these are not theoretical concepts that we look at. We actually do all of these things ourselves in our own property portfolio as well. So I think that covers most of the questions, or most of the points that Cyril had.
100%. So we have anonymous attendees who's saying, I have properties in my company I fully own. How much will it cost if I have to move company shares to a trust? That's a good question too.
It's a very good question. It's a difficult one, however, to give a quick answer on, because it depends on a couple of things. In certain aspects, you can change the shares with almost no cost attached to it. But if the properties are worth more than R1 million, technically you are supposed to pay the transfer duty when you are just changing the share of the company. So that is something to look at. Is your properties worth over R1 million or under R1 million? And then also, how much equity or capital gain have you built up since you acquired the properties? If there's not much, It could be very cheap to change the shares to the trust. If there's a extensive or a lot of capital gains that have been achieved, then we might need to look at how we can save those costs to keep it as little as possible to change the shareholding. But there's not it can become expensive when you have a big property portfolio and when there's a lot of capital gain that have taken place, and when your properties are over R1 million and the transfer duties kick in.
Okay, so we have another question from Yureen Manilek, asking, is it advisable to have an entity for each property? Hey, you guys have incredible questions. Yes?
I love these questions. These are really great questions. From a theoretical perspective, yes. It's great if every entity could have its own property, but from a cost or a structuring perspective and from an administration perspective, having one property in one entity could be overkill. So my personal preference is to have anywhere between 3 and 5 properties in an entity before I move over to another entity. And the reason for that is I always joke and say I conduct guerrilla warfare. It's much easier to have a light and small entity with not too many properties when you want to move quickly and get financing. Just from an administration perspective, think of all the rental agreements that the bank can ask for, and all the information that they require on a big entity with a lot of properties in it. So that helps for me.
100%. So one question here we have is from Anonymous Attendee, who's saying, how much does it cost to change shareholding of a company from myself, person sole director, to a trust, so that the shares in the company are fully owned by a trust? The company owns the properties. So this guy already done a good structuring there.
I think we covered that question quite well. It's not like I can give you an amount. It depends on the value of the properties, the growth that has taken place. It can be very affordable, but if it's a big portfolio, it can also become costly.
So we do have questions in the chat box, guys. I encourage you guys who are putting questions in the chat box to always put questions in the Q&A so we can be able to answer them. But we're going to take them now because we have like 4 more minutes. So video saying, is it wiser to leave property in your name if the market rental amount is less than your monthly installment, since it's not making any taxable gain either way? That's an incredible question there.
Thanks, Guido. That is a good question. Remember, the only reason for moving your properties to the right structure is not just for the tax benefit. Tax is one of 4 benefits that you have. You also have the asset protection component, the estate planning component, and most importantly, the component of building a bigger property portfolio. Because when you are sitting with a lot of debt in your own name, it might become difficult for you to start getting financing in your entities if you are not in a place where you can even sign for those those properties because you've got too much debt on your own name. And that brings me back to the basics of structuring, that is, as a property investor or as a business owner, you ideally want to be in a place where you've got no assets in your own name and where you have no liabilities in your own name, because that puts you in the best position to move forward and to build your property portfolio.
And also, as you mentioned, with regards to leverage too, I think that's something that's very, very impossible. Okay, that's sort of very, very good to do. So I think, guys, we're gonna. I think we have one more question here saying, if a company is making more than 1 million per year in rental income, is it my company supposed to charge VAT to tenants? And if so, so how do I best handle it? VAT is too much at me. Yeah, it is. It's
never mind admin. It's too much tax because you're going to pay that VAT and you're not going to really be able to claim any of it back. So suddenly you lose 15% of your rental income. Luckily or fortunately, residential property is not VATable, so you don't have to register for VAT. And then also, I mean, usually with the way we structure the entities, the annual rental income would be below R1 million before we move to the next entity. So we keep the entities non-VAT registered, meaning that you don't have to charge VAT on the transactions, which puts that 15% in your pocket as well. However, with commercial property, obviously, things start looking completely different, where you would go over the R1 million annual rental income, and where VAT is quite normal to be charged on rental.
So I think this is where we're going to be ending our session, guys. And thank you guys for attending. I hope you guys had like some very packed session with me and Jaco here today. I also learned a lot myself. I hope that you guys learned a lot from this session. One of the things I wanted to say, I gave you guys in the chat box. Let me know if you received it. You can get in touch with Jaco on his website. That's number one. And then he's also having a full day property investment online course that they're doing, I think on Saturday, right? Which you guys can be able to learn about all this structuring and more details and ask more questions. So I would advise you guys to look into that. And then I see that somebody's saying, are you able to give indication of monthly costs? Okay, sorry, are you able to give me an indication of the monthly running cost of a trust estimation? That's what TV is asking a question. So Jaco, in closing, as we close on the sessions, could you just say the closing remarks and also answer Octavia's question so we can be able to wrap up everything today? Yeah.
And 100%. You look at about, for a trust, somewhere between, let's call it between 300 and 500 Rand a month in your trust administration cost. Well, at least with us. I can't speak for other companies. So yeah, that gives you an estimate or so on. And then just from closing remarks, Ezra, thank you very much, firstly, for inviting me. It was great chatting to you today. And thank you, ladies and gentlemen, for joining. Thank you for the great questions that were asked. And
yes.
I want to encourage you, as property investors and aspiring property investors, to make sure that your structures are in place and that you put your structures in place rather sooner than later, because it just becomes more expensive to fix that later on in your life. And it was a lot of fun today. Thank you very much, Ezra.
100%. Thank you for joining us today, and thanks for everybody who's attended. I gave you guys our YouTube channel. If you guys want some replays, go check it out. Check out what Jaco and Prosperity are doing there. They're doing some great stuff. You guys must be able to check that out. We also give you guys an ebook link, so you can get all these links and be able to follow up and start investing in yourselves. And thank you guys for attending today. I think this is where we're going to be ending our session. And any more questions, anything else, send us an email and we can see how we can be able to help you. If you want us to connect you with Jaco also, but I already gave you guys an email, a website, so you guys get in touch with them. And we're looking forward to seeing you guys same time, same place next week.